This didn't exactly blast the markets, Michelle, but it
Mhm.
certainly moved them and I think left a lot of people wondering just what the Fed has opened the door to. What do you see?
Well, certainly the dot plot was a surprise. Even for myself, we had expected that we'd see maybe one rate hike in 2023, not two. And I think in the wake of some of the data that we've seen of late, particularly those inflation numbers, which for 2 months in a row have surprised market participants, the move in the dot plot raised concerns that maybe even though the Fed now believes that they, are not going to be raising rates anytime soon, that the timetable, as you said, might be tightened up, might be pulled forward. And you saw that, I think, priced in today as a result of sort of what the dot plot showed.
Well, I want to underscore this because it strikes me that this is a big change from March to June, Michelle. We're going to show you, you saw it, but if you look at 2022, for example, there's now 7 people out of 18 who think there's going to be a rate hike next year. That's up from 4. And in fact, 13 versus from 7 for one hike, but 11 FOMC members now see 2 hikes in 2023. There's a big shift here, and I wonder if the consensus on the FOMC is kind of moving ahead and moving away from Jay Powell's more conservative position.
Well, and even in the Q&A, I think you heard from Chair Powell himself, an acknowledgement that there are upside risks to inflation, and this is nothing new. But I do think that we've gotten to a point, particularly in the wake of the strong, not only inflation data, but the strong economic data. That has I think everyone feeling slightly less comfortable in assuming that the Fed is going to be able to be as patient for as long as they would like. And that when you look at it from a risk management perspective, and this is something we've spent a lot of time sort of talking about, and actually some of the FOMC members themselves have been talking about it. From a risk management perspective, you may end up seeing Fed officials believing that it is at some point sooner than they had anticipated going to be wise to take some action in order to ensure that inflation is not, doesn't move out of above target too far for too long.
Financial conditions is the other thing that we've been watching, right? And we've been looking at this chart quite a bit because it is pretty extraordinary. It shows the loosest financial conditions since the 1990s, which is, of course, why we also see the exuberance in the markets as well. Is this top of mind for the Fed, particularly as they've tweaked that reverse repo and the OER rates, given just the amount of distortion there is in the front end of the money market?
Well, I do certainly think that you've seen the Fed very cognizant of easy financial market conditions. You see in the financial stability reports that they are, they are watchful, but overwhelmingly, I do believe you've got a Fed that is really focused on ensuring that the economy does get to a place where all economic participants are feeling economic recovery. I mean, this has been a real shift that we've seen in the Fed. I mean, obviously they shifted their inflation framework, but they've also shifted to keep stressing the point that their mandate is now much broader, and they want to make sure that all individuals, when we look at the labor market, that across the board, that you're seeing, for example, unemployment rates decline across sort of all the various metrics, whether we're talking about gender, ethnicity, so what I think they really want to see is that the economy broadly is getting back to its potential. And that is something that the Fed, I do think overwhelming, while they're watchful about overstaying their welcome, they are going to be much more patient now because they do want to see confirmation, of this, kind of broader social improvement.
So, Michelle, given the fairly muted reaction in the market, given Asia is looking pretty, sanguine as well, we've also been looking at Asian emerging markets in particular building their dollar war chests ahead of this, right? Does this preparedness mean that we're not going to see a violent reaction when there is finally a reversal of policy?
Well, again, we have got so far to go before we actually see the Fed reversing course in terms of interest rates. With respect to the taper, we're probably, in our view, 6 months away before the Fed actually begins tapering its purchases. And the bottom line is, as you can get a sense of, even just with respect to tapering, there will be a long setup period. The Fed will go out of its way to fully prepare the markets. And so if we look at the taper discussion, today acknowledging they've started to talking about tapering, and in the coming months we think they'll add more color to that, and in September maybe getting more definitive about the timing, but all of this before actually taking action. And it will be the same on interest rates, and all of that then, as I think, will go toward the markets more gradually pricing in Fed action, whether it's tapering or on rate hikes, as opposed to some violent move at any one point. The Fed does not want to take markets by surprise. When they reverse course, they are going to go out of their way to make sure it's well anticipated.